American Giant makes great clothing, sweatshirts, jeans, and more right here in the U.S. Visit American-Giant.com and get 20% off your first order with code STAPLE20. That's 20% off your first order at American-Giant.com, code STAPLE20.
This is Scott Becker with the Becker Private Equity and Business Podcast. We're thrilled today to be joined by Holly Buckley. Holly heads up the healthcare department at McGuireWoods. In addition to talking to us today about healthcare private equity trends and what she's seeing, we're also going to do a quick shout out for the McGuireWoods Healthcare Private Equity Conference, which is May 14th and 15th in Chicago at the Ritz-Carlton. Spectacular event with nearly 1,500 attendees. If you're interested in that event, please reach Holly Buckley at McGuireWoods or just text Scott Becker 773-766-5322 and we'll get you to the right people. Holly, let me take a step back. Tell us what's going on in the private equity world currently, in the healthcare world. What are a couple of the trends that you're watching closely?
Hey, Scott, and thanks as always for having me on. A couple of things I think are super interesting that are either impacting deals or are just interesting trends. The first is the much anticipated new HSR rule is actually live and went into effect on February 10th. So this new rule is projected to lead to a substantial increase in the time and effort required to complete an HSR filing. So that's for those deals that are over the HSR threshold. And will apply unless the Congress or the FTC revises or revokes the rule, and there's also a lawsuit currently challenging the rule, but for now, we're up and running with the new rule. Few things to consider with the new rule. One, the burden of production is much higher, and the types of information that need to be produced are much greater. And so it's really important to get training for your deal teams and investment bankers, because certain types of information that wouldn't have been previously disclosable now are, such as anything that's gone to the board related to the deal. And so it's just really important that those drafts are all very carefully put together and that you're not just relying on the final versions. And it's really important to bring HSR counsel in much earlier to avoid delays, because it's no longer going to be something you can likely complete in 5 to 7 days. So we've been kind of waiting for this one, wondering if it's going to get pulled back, but for now it is actually live again.
Fantastic. What does that mean for deals? What are the new thresholds? How much more complicated is this going to make getting deals done? Right now, unless you're doing huge deals, it seems like the HR doesn't become that big a problem. At least for most private equity-driven deals. Once in a while, for a big private equity-driven deal, you get a second request. Certainly on the healthcare side, the hospital side, the government often blocks hospital deals where they think there will be market concentration. But generally, for the PE bolt-ons and so forth, it hasn't been that much of an issue. What's your sense, and what are people saying out there?
Yeah, so I mean, anything that's below the threshold, which it's not just a straight enterprise value threshold, it's a complex equation to kind of get there, but around $120 million. If you're under that point, based on the calculations, you don't need to do an HSR filing. So that hasn't really changed. The bigger change is around the type of information that's going to be produced, and where it's going to get more complicated, where the corporate structure is more complicated, but also, to your point, Scott, where there is more overlap on geographic area and overlapping products and services or overlap on suppliers, that's where the burden is greater and it's going to be more complicated. So I guess an easy way to think about it is, for the transactions that generally would have more of an antitrust impact, whether real or potential, those are the deals that are going to have a much larger review, much larger production, and probably longer timeframes and more likely second requests. For the transactions where it's party A buying party B and party A is not currently in the line of business and doesn't have overlap, I think there's not going to be an awful lot of change, although the initial disclosure will be greater. So I think for those deals that do implicate antitrust laws, you can expect a longer, more painful ride.
Thank you. And that makes sense. Thank you very, very much. And tell us what else you're watching out there. The new HSR rules. I think some people, I think we're hoping those go away under a Trump administration. So far, not so much. So what else are you watching?
Yeah, so last year, one of the big state laws that everyone was very focused on was the California Senate Bill 3129, which would have, if it had gone through in certain of the forms that it was proposed, would have almost prohibited kind of MSOPC, kind of the private equity investment in medical and dental businesses. And Newsom ended up vetoing that law. It got all the way to his desk, and then he didn't sign it and said, look, we already have a process for this. We're not going to kind of go this far and sign this. But now there's a new California bill that's proposed, which is Senate Bill 351. This came out in the last week or so. This is very, very watered down compared to what was proposed last year, and it's much more of a corporate practice bill than it is an antitrust bill or a real kind of transaction bill. But essentially, it prohibits PE funds and hedge funds from interfering with the professional judgment of physicians or dentists in making healthcare decisions and exercising power over specified actions, including decisions on billing and coding and patient care services. So in a way, this bill is somewhat of a nothing burger in its current form, in that those prohibitions are already live in the as far as the medical board goes, and this would just be giving the attorney general power over it. And so we don't consider this to be a big deal, but it's interesting that California, after kind of failing last year to get their law passed, is kind of back again. We'll see if this evolves, if it gets modified, if it gets more prongs to it, and if it ends up creeping back towards 3129. But really just interesting that California is back for another bite at the apple after the failing last year. And that goes with a number of other states, as we've talked about in other podcasts, that are coming out with their AG laws to have pre-transaction filing notices and disclosure requirements, and just a lot of activity at the state level that's implicating transactions and creating a whole other level of work and time for investors.
Thank you. And that's the kind of thing that's going to just be additional headaches for people doing deals, correct? I mean, that's really what that sounds like, just additional headaches. Right now, most private equity sponsored companies don't at least intend to get in the middle of professional judgment. Though I guess you could say anything does so. But what do you see there?
Yeah, I mean, I think it, in a way, just kind of creates something else to fight about, right? So I think you're right. In general, PE funds are not looking to get in the middle of professional judgment. There's very few private equity professionals that hold medical degrees, and they're really looking to streamline the back end, infuse capital for growth and improvements. But it creates something else that can be used as a sword or a shield. And I don't necessarily think this is going to be super impactful, but I think it will continue to create a disincentive for some folks to invest in California, as it continues to be a very difficult state.
Thank you. And what else are you watching? We're talking about the HSR rules. We're talking about new state rules. What else are you watching currently?
Yeah. The final thing I was going to flag is what I think is just a super interesting trend, and it goes with the theme of funds looking, healthcare funds looking at things to invest in that aren't direct reimbursement, direct provider services companies. And it's not that funds are not making those investments, but we're seeing a big trend toward diversification to invest in things in the healthcare orbit, because it's still just a very dynamic space with a lot of potential and a lot of room for improvement. But one of the areas that I think is super interesting is funds investing in healthcare consulting companies. And I was poking around this weekend and found, a fair amount of these. And we've seen VMG, the kind of valuation and other healthcare consultant services business, has PE investment. Coca Group took investment from Trinity Hunt. Chartis from Blackstone, and Chartis is the parent company of Gerard, which is the healthcare PR firm. And we're also seeing investment in consulting companies in the pharma services sector. And so just an area that is interesting as a professional services professional myself, to see private equity kind of moving into these other professional service spheres and kind of looking at how they can grow and combine and elevate. So I think super interesting. We'll be talking about that at our conference in May as well, but just yet another area that we're going to see a fair amount of development.
No, thank you. And I know that we happened to have VMG on our podcast yesterday talking about cybersecurity risk in due diligence transactions. So a lot of that out there. No, thank you very, very much. And Holly, so you've got new HSR rules, some of the new state rules on private equity deals. You've got private equity a little bit slower into the specific provider area, but certainly heavy into the consulting area, the revenue cycle area, digital health area, and lots of other areas. Anything else that's top of mind currently for you that you're watching?
No, I mean, I think it's a lot of the same stuff we've been talking about. We're seeing a fair amount of exits, both kind of getting started and also underway and having just closed. So the exit market seems to be relatively strong. Also seeing some good new deals come to market. And so I think we're still optimistic this is going to be a good year, probably not a great year, but a really solid year. But the three we've talked about are the ones that are really top of mind for me.
Thank you very, very much. Thank you, Holly. Always fantastic to visit with you. We'll keep on following up with you. Again, Holly Buckley chairs the healthcare department at McGuireWoods, just absolutely brilliant leader in the healthcare private equity sector. Thank you very much.
Thank you.